Hello, everybody. Welcome. Thank you so much for joining us for today's webinar. I am Betsy Kenyon, Marketing Coordinator at Elevate Wealth Advisory, and I am here with Clarke Holt, one of our wealth advisors who has been with Elevate for many, many years now. Are we on 21 going on 22, Clarke?
It's actually 22
At 22 going on
going
23.
on 23.
Yes, so we always love when Clarke comes and joins us, and today he is helping us with retirement planning. He has created a guide, a structure for your retirement planning, whether you're a pre-retiree or a current retiree, and this is going to offer you all kinds of tips and tricks. And so I'm so excited to have you with us today, Clarke.
Thank you. Glad to be here.
So tell us a little bit about what you have going on. What is something that you are reading, watching, or listening to that you're excited about these days?
Okay, so reading, I actually started a book a while back, and I'm not fully committed because I don't take the time, but it's a good book. I took it to the beach, and it's called The Money Trap. It's and the lost illusions inside the tech bubble, and it has to do with the company SoftBank and their former CFO and all the stuff that went on during the dot-com bubble with Yahoo and T-Mobile and Nvidia and the just these massive investments that SoftBank made and all the behind the scenes stuff. So that's kind of interesting. And then watching is probably lots of different things. Things like The Lioness and The Agency, whether that be Paramount or Netflix. And so there's plenty to watch, and there's a lot I got to catch up on. So
Oh, very cool. Very cool. Just some light reading at the beach.
right. About venture capital and
Yeah,
investments.
right. Just
Yeah.
something
I
to,
mean, right.
just some light reading while you're out in the
Right.
sun. Well, thanks so much for joining us today. And I'm going to go ahead and let you share your screen and take it away.
Okay. Thank you, Betsy. I appreciate it. Give me 1 second here. Okay. Everybody should be able to see this first slide with the title. So this is a presentation I put together and just called it Guide to Retirement. And it's a lot of informative, insightful ways to kind of have an effective framework for supporting your retirement plan. And that's what we want to go through today. And there's lots of good content. I actually had to um, not include a lot of slides because it would have been probably an hour presentation. So we want to keep these informative, educational, but just respecting your time and tried to highlight just things I think would be most insightful as we go through these. And so let's get started. So the big thing with retirement that I think people are sort of get caught off guard with is that you may be retired much longer than you think. And it's through this, as we go through this guide, you're going to have questions like, will I be able to maintain my lifestyle? Will I be able to meet all my expenses? Can I retire now? Should I wait? And then how should my assets be allocated? Um, and the biggest question of all, and the most pressing one that we hear retirees and pre-retirees that I speak with is, will my money last? And a lot of people are concerned and wonder, will they have money left over for their loved ones? And so lots of questions will come up. We hear these time and time again. And the thing we've learned, I think, that I've learned is there's one thing if you want to come away with today is it's that you should consider just a practical, usable plan to navigate this new retirement territory. So when we look at the risks, the 5 key risks of retirement, um, that could potentially derail your retirement plan, it's longevity, healthcare expenses, inflation, how we're allocated or our asset allocation, and withdrawals or excessive withdrawals. And every pre-retiree and retiree should plan for these risks. So when we're planning for retirement, it can be overwhelming. There's lots of factors that are out of our control. We talk about controlling the things that we can control. Obviously, we want to do that, but there are things that are out of our control, such as market returns, regulatory reforms, tax policy, things like that. There are some factors that we have some control over, and that might be things like longevity because of how we might manage our health, how we take care of ourselves. Also, things we have some control over is how long we might work or how long we will work and earn an income. And really, the best way to achieve a secure retirement is for individuals to focus on the factors that can be controlled. And we've talked about that and talked about that in meetings and other presentations. So things like maximizing savings, just managing spending, uh, utilizing tax advantaged accounts, and just being well diversified in your investment strategy. So um, the longer you live, and the increased years you get by being healthy, a non-smoker, are significant. And so this chart shows the probability of us of 65 of a 65-year-old man or woman today and reaching various ages. And the bottom part of the bars show life expectancy for a healthy non-smoker. And then on the purple bars, half of women will make it to at least 85, and more than half of female non-smokers in excellent health will pass age 90. And men are not far behind that, with about 4 in 10 healthy non-smoking men expected to surpass age 90. So we've got a plan for longevity. And so while people are continuing to work later in life, not everybody can do that. There's really a high percentage of those who are currently working, um, expect to work to 65 or later, but the actual experience of retirees is quite different. So about a third of retirees said that they retired earlier than expected, primarily due to their health or disability or due to changes at their company. And I've heard that story from lots of people, as far as how the dynamic at work can change. If your company gets acquired, if management changes, if the philosophy or the culture changes, it may force you to retire early. And it's very important, that people have a financial backup plan if they're not able to work. Um, and you've got to consider, obviously, your individual and your family is highly dependent on that income from employment. So as households transition into retirement, um, time that we have spent working is now available kind of for other pursuits. So individuals often enter retirement having spent very little time determining how they want to plan to spend their retirement years. And they run the risk of not enjoying retirement as much as they thought they would. So to age well, you want to consider several things, and it's really, if you boil it down to four things, it's purpose, use, socialize, and health, and that just will help us flourish more in retirement. In planning ahead before you do retire on what that will look like, what are your activities going to be, hobbies, maybe part-time work, is important to having a successful, fulfilling retirement. So these next couple of slides are really a matrix, of different scenarios, and I'll walk you through these real quick. So, trying to achieve a financially successful retirement is going to require consistent savings, disciplined investing, and a plan. And this first slide looks at household income, um, 90,000 and below, 30,000 to 90,000. And it's got an annual savings rate of 5% and a pre-retirement portfolio and a post-retirement portfolio. One is a little bit more conservative than the other. It's got an inflation assumption. And it's basically saying if you've got 35 years in retirement and you retire at age 65. So for example, what you find the intersection on this matrix, of your age and your current household income. And what that tells you, that number at that intersection will tell you what your current savings amount should be. And so, for example, if you're 40 years old and your income's 50,000, you should currently have about 100,000, a little over 100,000 saved already. If we look at higher incomes, 100,000 to 300,000, and an annual gross savings rate of 10%, all the other assumptions the same. Again, if you're age 40 and your income is 100,000, then your current savings should be 200,000. And so this is just kind of giving you an idea and a framework of where should I be with my current savings. And then if we look at this next slide, how much should we save for retirement? And it really depends on our circumstances. The lifestyle that we have, things like that. And then this chart shows the percentage of gross income that may need to be saved if you're starting at various ages. So, for example, for a current 25-year-old with these levels of household income, the annual savings rate is between 3 and 8%. But if you look at like a 50-year-old, for example, they may need to save between 29 and 39% of their gross income, which is really unrealistic. And so for most households. So the key is the sooner you start and the more consistent you are, and also increasing your savings gives you a better chance of having success in retirement. And this slide is incomes from 100,000 to 300,000. Again, we can see the amount of household income you would need to save annually if you're starting at these various ages. So if we look at a scenario, or we look at a scenario with four hypothetical investors or people, individuals. So, saving and investing early and consistently is important. We know that. This chart just looks at the different retirement outcomes based on various saving and investing behaviors. So we're looking at consistent saver in the green. We're looking at early saver and investor, consistent saver and investor, and late saver and investor. And if you're a consistent saver, that's great. But if you're saving in a CD or savings account or checking account or money market, the average return that you get will not be enough to outpace inflation, or maybe just close enough. And so we've got to be not only a consistent saver, we've got to be a consistent investor and getting market-like returns so that we can have a sustainable income in retirement. And you can see the blue line, the consistent saver and investor has an ending portfolio value much higher than the other three scenarios. So as a result, if you want to create wealth, not only for your retirement income, but also leave a legacy, you want to be consistent. You want to start early, be consistent, and also invest appropriately. And then increasing contributions each year can be an effective way to save for retirement. And this chart shows three different people, three different hypothetical scenarios. Each have a starting salary of 50,000 that increases with inflation, and they have 100% employer match at their workplace retirement, and that's capped at 5% in this scenario. The saver who contributes 3% throughout their career is in the blue, and they're far behind. But by leveraging an auto escalation feature, or if you can increase that consistently or escalate that manually even, that starts at 3 and gradually increases to 10, the saver in green ends up not far behind the person that contributed 10% the entire time. So if you're able to start small, you do want to escalate or increase that savings rate, so that you can continue to compound wealth and grow. And that portfolio, if you look at those two scenarios in the green, the one that escalated from 3 to 10, and then the one that consistently contributed 10, values exceed 2 million. at the end of the for the ending portfolio value. So this is a matrix of different tax advantage savings accounts. They have different tax characteristics. Investment growth is usually tax free, as shown with the plus sign in the middle column. For retirement accounts, pre-tax and Roth, the top two rows, money may go in or come out tax free depending on the account type, and if deposits and withdrawals are qualified. HSAs, which have to be paired with high deductible health plans, offer triple tax benefits if the funds are used for qualified health expenses. Um, and really, non-deductible and after-tax contributions are less tax advantaged and should kind of be considered after exhausting other opportunities. But again, there's so many great ways to save for retirement. And we've talked about before different buckets and different tax characteristics of the types of accounts that we invest in. All of these accounts are designed for long-term savings. So generally there are penalties on early or non-qualified withdrawals. And when we're looking at saving for retirement, we got to prioritize how we save that next dollar. How should it be saved? So factors like liquidity needs, employer match, if that's available, contribution limits in various account types, um, and like loan obligations should be considered as well. So the first savings priority should be an emergency savings, and having an emergency reserve in case we have some sort of a surprise or income shock, if you will, or we lose our job. We've got to have money to pay our expenses for a period of time until we can find a new job, a new income. And so that's where we hear that 3 to 6 months savings to have set aside, so that's about how long it should take someone to find another job if they were to lose their current job. And so you want to just take care, first of all, getting that free money from that match as well. And unless there are relatively high interest loans, putting more funds in retirement accounts or health savings would be right next on the list. So a lack of savings, we talk about emergency savings, can really impact our retirement readiness. According to some research, 9 in 10 employees experience significant spending spikes, um, defined as like 25% more than their baseline spending over the previous 12 months. So more significantly, 1 in 3 who experience these spending shocks are unable to fund them out of savings. And so what they end up doing is they lean on credit card debt. So you can see there's um, households can lean on credit card debt, increasing that, 40, kind of a 48% number there. 17% would take a loan out of their 401k plan, and 13% would actually decrease their contributions to their retirement plans. So building that emergency savings is very critical. So if we're looking at 401k participants as they enter midlife, they may have been able to build up a 401k balance just as they're starting to experience life events, such as could be buying a house or buying a second home. Maybe they've gotten too big for their starter home, so they're moving on to a larger house because maybe there's family, there's kids coming along, things like that. And this chart just shows that the prime time of life for both revolving debt, which is credit card balances, um, and then that are not paid off each month, and then loans from retirement plans. And so again, having that emergency savings account for unexpected expenses and saving outside of a 401k for other goals is very prudent and a wise plan. So saving early, and again, dedicating that first dollar to an emergency savings before you do anything else is very important. When we look at the effects of inflation, so when we have periods of high inflation, it's important to look at long-term um, inflation in our retirement planning forecast. So different categories of spending inflate differently, and households spend very differently at different ages. So we've got to actually, so households do not experience inflation to the same degree. Not all households do. Older households have to plan for really higher healthcare expenses, healthcare inflation, including the fact that they're going to use more healthcare as they get older. For some retirees, housing inflation is not as much of an issue um, if they own their own home outright, since housing inflation includes like, inputted rent and things like that. Um, and while all households are affected by food and beverage inflation, those age 75 or more spend a smaller share of their budget than younger households. So taking that longer term view and planning for inflation in your retirement plan can help set you up for a successful retirement. So this chart looks at partially and fully retired households with 250,000 to 750,000 of investable wealth. And they spend different categories that, specific, there's different spending on categories at different ages. The trend is generally downward sloping in the early part of retirement and then relatively flat in later years. So partially retired households have a mix of income from work and retirement income. And again, when we talk about retirement income here, it's going to be from pensions, Social Security, things like that. This is the same chart, but looking at households with 1 million to 3 million of investable wealth. Um, Again, you can see the different spending trends, and the largest expenditure category at all these ages is housing. While the category that older people spend significantly more on than younger people is healthcare. And so we know that, and we have to prepare for that. And then housing and healthcare may increase late in life due to the possibility of needing long-term care. Spending really can fluctuate more than 20% per year if we're looking at retirees. And even though spending tends to decrease starting at midlife, there's a significant variation from year to year for many retirees. So recent retirees will need to prepare for a sequence of return risk near retirement and have that flexibility for variable spending as they get older. And if we look at total retirement wealth between 1 million and 3 million, the more guaranteed income you have, or let me put it this way, more guaranteed income equals less fear of spending. So total retirement wealth is defined as retirement accounts plus guaranteed income. And so for a given level of wealth, having more guaranteed income results in more spending in retirement. This may be because people feel more comfortable spending pensions and Social Security while they're more reluctant to spend the capital in their investment portfolios. And this next slide is looking at another category of 3 million to 5 million. And again, more guaranteed income equals less fear of spending. So JP Morgan did a study this year, 2025, and they looked at portfolios that are 40% equity and 60% bond as a hypothetical, which is a conservative portfolio. And they looked at a 4% initial withdrawal rate. Um, and then again, trying to look at scenarios of not running out of money before 30 years. The results were um, Yeah, obviously based on market performance, things like that. And if you look at the 4% rule, based on this scenario, if you look at 67 rolling 30-year periods from 1928 through 2024, one in four times investors may have had five times the amount they started with at the end of retirement. This may be a positive outcome for investors if their goal is to leave a legacy. It might be a poor outcome if lifestyle sacrifices were made all along the way in their 30 or 35-year retirement span. Um, and so the 4% rule is helpful as far as a withdrawal rate. It's a helpful rule of thumb to understand the maximum withdrawal rate that has a very high confidence of not running out of money. It's not really an efficient withdrawal plan for households that want to use their retirement wealth to support a fulfilling retirement lifestyle. And this chart just shows various portfolios, six different portfolio models, and then also withdrawal rates on the left. The portfolio models are across the top. And then a low withdrawal rate may unnecessarily restrict spending and lifestyle during retirement, while a high withdrawal rate kind of runs the risk of failure. And it's important to note that failure on this chart means risk of running out of funds. And so portfolio allocations show that the more equity that we have, there's a lower chance of failure. But we shouldn't just, an individual or a family should not necessarily assume that means that more equity is always better. More equity means more volatility, which can lead to behavioral issues if we're uncomfortable or if we're risk averse. And so it's important to have a well-diversified, balanced portfolio and also a sensible withdrawal strategy and being flexible too, and maybe having a dynamic withdrawal strategy and spending only when we need it and maybe changing our spending over time. Sequence of return risk happens when there's a lower negative return pattern just before or right at or early in our retirement. And this chart, this at the top of the chart and the teal line and the bottom chart, which is, bad start, great start. I'm sorry, bad start, great end scenario. And so experiencing this scenario can put us at more risk of running out of money, which is a concern for a lot of people. If they start taking withdrawals from their portfolios to sustain their lifestyle, even though the overall average return is the same as the gray line, which shows steadily average returns, and the purple line, which shows positive returns early and more negative returns late. So again, we've got to pay attention to sequence of returns risk, and we have to be flexible in our spending and have a sensible strategy if we need to cut back on what we are withdrawing from our retirement accounts so that we can put ourselves in the best position to have a sustainable long-term income. Retirement timing risk is when an investor retires at the beginning of a bear market. This can put a portfolio in a position of the sequence of return risk, which is, poor market returns at the beginning of retirement. This may have a significant impact on outcomes and the overall wealth that you create. And so the bottom chart shows the returns experienced from 1966 through 2000. And with below average or negative returns in many of the first 10 years, uh, resulting in the accelerated depletion of assets by the age of 89. And we all know we're living longer because we're healthier. And so we have to plan for that. So there was a retirement plan survey in 2024 where participants were asked to rate their risk tolerance from aggressive to conservative on a scale throughout each decade from their 30s to their 80s based on how they've invested their retirement savings and plan to invest in the future. So the percentage of participants who began to consider themselves conservative or moderately conservative as they approach retirement and through their non-working years significantly increased. A target date fund, oftentimes we find in our retirement plans that automatically adjust as participants get older, may help them stay invested if they're worried about the markets declining as they near retirement. Oftentimes, retirement planning software and retirees' goals may not always match in terms of how they're going to fund their retirement. So, for households with increasing wealth, investing on a total return basis may be looking at a longer time frame for legacy wealth. That should be considered. Many households, their desire is to just preserve principal and end retirement with the same wealth as they started with. And so for these households, investing for current income may provide them with the funds they need to support their lifestyle. And increasingly, we see households that may need to use a portion of their wealth or spend principal to support their retirement lifestyle, especially as access to pensions declines. And these households really should consider several options: a dynamic withdrawal strategy that can provide needed funds while making sure that the principal is not depleted too quickly. And just aligning retirement assets based on how how we will um, use to support an individual's retirement lifestyle is one way to ensure kind of a higher degree of confidence through retirement. And this chart is showing that stable spending can be aligned with relatively safer guaranteed funding sources, and more variable spending can be covered by investment income from investment accounts, retirement accounts, consuming principal or a cash reserve. And if a legacy goal is what's important to you, leaving money for your heirs, then other strategies may make sense given the longer time horizon. So if we're trying to achieve multiple goals and with varying time horizons and savings requirements, that could be challenging if wealth and savings are grouped all together. So for greater clarity and control, we could consider using a goals-based wealth management approach. And that's just where assets are invested according to the time horizon of major goals. And you can see that on this chart from short term to medium term to long term. And the savings required to achieve each goal is determined and managed on an individual basis. And this goals-based approach is really most successful if there's an emergency reserve big enough to fund the spending and income shocks throughout the year. So going back to that, one of those first slides, having that emergency reserve is very important as we go through trying to plan for retirement. And when we look at periods of extreme market declines, it's natural to be emotional and to have emotional reactions, and that can take we can be an example would be selling out of the market and seeking safety during a decline or during a bear market. And this is loss aversion. This is the fact that losses hurt more than gains feel good. And the results of this can be hurtful and devastating because during periods of market volatility, the best days are likely to occur close to the worst days. So we want to stay invested fully throughout. And this chart compares an individual who was fully invested for the past 20 years in the S&P 500 to an investor who missed some of the best days as a result. But again, Oftentimes the best days occur very close to the worst days, and that's important to remember. So missing the top 10 best days reduced the annualized return by almost 50%. And missing the top 40 days resulted in a negative annualized return on the original $10,000 investment. So staying the course with a diversified long-term investment strategy, it may likely produce a better retirement income outcome. Sorry. We want to focus on what we can control and control it. And again, we touched on that on one of the very first slides. There's things that are out of our control that we should not focus on. There's things that we can somewhat control, like our health, how long we work, and there's things that we have a lot of control over, and we want to focus on those things. And so you want to partner with a skilled advisor who can give you that objective experience guidance. Have an investment plan, know what your risk tolerance or your risk profile is. You want to structure a portfolio the right way, appropriately, and diversify globally. We want to manage our expenses, our turnover, our taxes, and just maintain that long-term view and that long-term perspective. And then just stay disciplined through market dips and swings and stay invested. So we've talked about these things before. Many people that will are watching this or will watch this later from our YouTube channel will have heard us talk about focusing on the things you can control. And that's very important. All right, so that concludes the presentation. I hope you enjoyed it. I hope you found it insightful. If there's things uh, that you want to discuss one-on-one and you have a question about a particular slide or a graph or just specific numbers, you can reach out to me. I'm happy to answer any questions or spend time with you one-on-one.
Thank you, Clark. That was wonderful. I wish I had seen this 30 years ago when I first started earning income. So I just will encourage anyone watching, if you have kids, definitely pass this on to them. This is really great information, no matter what age you are or what part of your life that you're in. So we do have some questions, Clark, if you've got some time.
Sure.
All right. And then if anyone else has additional questions, we have a chat box and a Q&A box. But our first question is, how can I plan for legacy and estate matters to protect my loved ones?
So a lot of retirees are worried about how their assets will get distributed after their passing. And so my advice is make sure that you have either created and or updated your wills, any trusts. Make sure, again, all your estate documents are in order and reflect your current wishes, and that your beneficiary designations are as they should be. And just ensure that your wishes are crystal clear. And you might also consider how to support family or charitable causes. Um, and at the same time, you can preserve and protect your financial stability while you're retired.
Excellent. Our next one, this is a good one because Clark is doing a series of videos in July on our YouTube channel. And this is one of the things that you'll talk about later this month. So, but the question is, when I retire, what will give my life meaning and purpose since I'm no longer working? How can I stay socially connected and maintain a sense of purpose?
That's a great question, and it's one of the things that people that are retiring do not think about, or they're surprised by, or get caught off guard. And we did touch on that in this last series. But that question that's the psychological transition into retirement. So from a kind of a career focused identity, and then how do I find a fulfilling retirement now that I'm not working? Because we have those connections, we have the structure um, over all these years we've been working. And so you want to look, how do we replace those relationships, hobbies? And really it boils down to kind of reconnecting, focusing on the relationships we have, making new relationships, looking at hobbies, volunteering, travel. It might be that you've got some sort of encore part-time job in retirement, which can give us kind of if really a fulfilling retirement, but retirement can lead to feelings of like isolation. You've got a loss of identity, especially for those who had social and professional fulfillment. So just again, engage in meaningful activities like volunteering or hobbies, and just stay active and connected.
Excellent. And this last one is how can I, this is a big one I think a lot of people worry about. How can I ensure my retirement savings last throughout my lifetime?
So that's a big concern with pre-retirees and then retirees as well. I think it boils down to a lot of the stuff we covered earlier. It's start early, save and invest consistently, and try to escalate our savings. And we also want to invest appropriately. And how do we do that? How do we appropriately diversify and structure a diversified portfolio? And you want to plan on a sustainable withdrawal rate. We kind of talked about that earlier, that 4%, that 4% rule. We want to be able to adjust that for inflation, have that emergency savings so that we don't have to tap into our investment accounts or our retirement accounts if we have unexpected expenses. So it's optimal to have a balanced approach. So investments like obviously stocks, bonds, cash, just to maintain that financial security so that we can cover our health care and our living expenses in retirement.
All great ideas. Thank you so much, Clark. We always love your insight and we thank you again for all the time you put in. Like I
Absolutely.
mentioned, if you go to our YouTube channel, youtube.com, and look for Elevate Wealth, that's the name of obviously our company, but also our series. And like we mentioned, Clark is focused on retirement planning all month long in July. So he is giving lots of really great tips for retirement planning. And he goes into a little bit more detail about these different subjects that everyone asked about today. So always a good resource. Thank you so, so much, Clark.
You're welcome.
We're very lucky to have you with us.
Thanks, Betsy.
Thanks. And if you all have any questions, you can email marketing@elevatewealth.com. I'll make sure that Clark gets your email and your questions. And then if you would like to come on in and meet with any one of our advisors, you can go to our website, elevate-wealth.com. Just click Let's Talk and you can fill out that form and we'll get you connected. Thanks so much, and we'll see you all next time.